Hello viewers, welcome to my channel. I am Hasham Khan. So now I am going to start a new topic in the subject financial statement analysis. The new topic is cash flow analysis. So in the last video I have explained you that there are different techniques of analyzing the financial statement. So the first very important technique was ratio analysis. Already last videos I have completed the theory, problems, everything I have completed in ratio analysis. Now the second most important technique of analyzing the financial statement is cash flow statement. So right now in this video I am going to explain you about the meaning of the term cash flow statement. What are the differences between cash book and cash flow statement? What are the differences between funds flow statement and cash flow statement? What is the importance of making this cash flow statement? What are the provisions given by AS3, Accounting Standard 3, issued by ICAI regarding the preparation of cash flow statement? What are the different terms which are used in cash flow statement? The meaning of all those terms I am going to explain you in this video. So watch the video till the end, don't skip in between, because this video will explain you each and everything about preparing the cash flow statement. Later on, when we do the problem, you will be perfect, you will be completely acquainted with all the concepts which are used in the problems. In other words, I can say this theory is the foundation for all the problems ahead. So if you are having a strong hold on this theory, then definitely you can enjoy, you can learn, you can understand the problems very easily. That means whole problems are dependent on this theory. So don't skip. Each and every point is very, very important. That will be helpful in doing the problem. So let's begin with the topic cash flow analysis. The cash flow statement. The cash flow statement is a statement which is prepared to show the cash balance from one period of time to another period of time of an organization. Simply, cash flow statement depicts the changes in cash position. Changes in cash position from one period of time to another period of time. That means from where there is cash inflow, where there is cash outflow. The movement of cash from one period of time to another period of time, that will be depicted by cash flow statement. Cash flow statement. This is the meaning of the term cash flow statement. Now a point will arise. Already cash book we have. Then why there is a need of making this cash book? So I'll explain you the differences between cash book and cash flow statement. Both have the similarity. In cash book, we will begin with the opening balance of cash. We record all cash receipts. We record all cash payments. We will have the closing balance of cash. Whereas in cash flow statement, again we will have the opening balance of cash. We record all cash inflows. The cash receipts are called cash inflows and cash payments are called cash outflows. So we can say opening balance of cash plus cash inflows minus cash outflows is equal to closing balance of cash. That is the similarity between cash book and cash flow statement. But the difference is, in cash book we record each and every transaction which involves cash. Whether we are receiving the cash, whether we are paying the cash, all the transactions will be recorded, everything will be recorded. But in cash flow statement we divide, we categorize the inflows and outflows under specific heads. We divide all cash inflows and cash outflows under specific heads. That means what are the cash inflows and outflows from operating activities, what are the inflows and outflows from investing activities, inflows and outflows from financing activities. We categorize it in cash flow statement. That is the difference between cash book and cash flow statement. Now I am going to explain you about importance of cash flow statement. The importance of cash flow statement cannot be overemphasized. It's very, very important because it will give you a lot of information about the cash, about the movement of cash. Now each and every point I am going to explain you in detail regarding ascertaining net cash inflows. The cash flow statement will help in ascertaining the net cash inflows and cash outflows of the activities relating to the main activity of the business, operating activity of the business, and financing activity of the business, investing activity of the business. So this will help in ascertaining what is the net cash inflow. Net means outflow, inflow and outflow. Inflow minus outflow will give you net cash flow. So we can be able to get net cash flow from different activities of the business. That's the main. We divide all activities into three categories: operating activity, investing activity, financing activity. Secondly, short-term financial planning. This cash flow statement will help the management in short-term planning. That means in advance we can decide, will there be any surplus of cash so that it can be better utilized, or there will be any deficiency of cash so that we can be able to make the arrangement of short-term finance. The planning, short-term planning will be facilitated by this cash flow statement. It will help the management in making short-term financial planning. Next one, evaluation of financial performance. See here, nowadays many analysts says cash is the king. They will not give much importance to profit. They will give the importance to cash, because many times it may happen that an organization may show huge profit, but the organization is facing cash crunch problem. It's difficulty in the liquidity position of the problem. The business will not have sufficient cash to meet the obligations on time. So instead of giving more importance to profit, we should give equal importance to cash also. So for evaluating the performance of the organization, cash flow statement will be very, very helpful to the analysts. Next one, evaluation of financial position. The financial position will also be depicted from the cash flow statement. How? Investing activities. If the investing activities shows that there are more cash outflow from investing activity, that shows that the financial position is not good. The business is selling most of the fixed assets. Similarly, financing activity. In financing activity, we will see more inflows are there from long-term debt, from loans, etc. Then again, it may be an indicator of bad financial position. The financial position can also be indicated from this cash flow statement. Next one is efficient cash management. See here, cash should neither be in shortage nor there should be excessive cash. If we hold excessive cash, our profitability will come down, because idle cash will not generate any income. It will incur cost. So properly we should utilize. If a business is having surplus cash, it should be invested so that it should earn some return. So in this way, cash management can be done with the help of cash flow statement. Facilitate comparison. By making this cash flow statement, we can compare one organization's cash flow statement with another organization's cash flow statement and see the operating performance. How the business organization is performing compared to other organizations, other competitors. The comparison will be facilitated by making cash flow statement. Next one is facilitate capital budgeting decisions. See here, capital budgeting decisions are the decisions relating to acquiring the fixed asset, purchasing the fixed asset. The capital budgeting decision requires the flow of cash. Once an asset is purchased, then it will evaluate how much cash inflow will be affected. Cash inflow and cash outflow both will be affected in capital budgeting decision. So in capital budgeting decision, we need cash flows. So this cash flow statement will be very, very helpful in making capital budgeting decision whether to acquire a fixed asset or not. So many capital budgeting techniques are available which requires cash flow, and this cash flow statement will provide the cash flows. Next is capital structure decisions. Capital structure is a combination of owner's fund and borrowed fund. Capital structure is a combination of owner's fund and borrowed fund. So this cash flow statement will help in understanding the capital structure and taking the decision for making a proper capital structure. Next one is aid in decision making. The management has to take a number of decisions which affects the cash position. Example, dividend to be declared. How much a dividend to be declared? This declaration of dividend will have an impact on cash position of the business. So before taking a decision on dividend declaration, the management will see the cash flow statement, whether proper cash is there or not. What will be the impact if we declare the dividend? Similarly, for repayment of loans, if we have surplus cash, is it better to make the repayment of loan or redemption of loans like that? So this cash flow statement will help the management in decision making. Lastly, estimate future cash inflows. By using the past cash flow statement, we can get the insight into the size, timing, certainty of future cash flow statements. So this shows the importance of cash flow statement. That is the reason why throughout the world, this cash flow statement will be prepared for analyzing the financial statements. And it is treated nowadays as a part of financial statements. That's all. So now I'm going to explain you about the differences between funds flow statement and cash flow statement. These two are the financial statement analyzing techniques. Both will have similarities as well as differences. Cash flow statement is funds flow statement is a statement which is prepared to show the changes in funds. Changes in funds from one period of time to another period of time. And cash flow statement is a statement which shows the changes in cash from one period of time to another period. Both are prepared from the same data. From the same data we can make funds flow, we can make cash flow. So similarities are there, but many differences are also there between cash flow statement and funds flow. In examination, you may get a theory question regarding what is cash flow statement, what are the differences between cash flow statement, cash book, what is the importance of cash flow statement. I have explained you in detail. Another theory question may be asked, what are the differences between funds flow statement and cash flow statement. First one, funds flow statement. In funds flow statement, the meaning of fund is working capital. The meaning of fund is working capital, and working capital denotes current assets minus current liability. The funds flow statement will show the changes in funds from one period of time to another period. What do you mean by fund? Fund means working capital. But in case of cash flow statement, the meaning of fund is cash, not working capital. There in funds flow statement, meaning of fund was working capital. Here in cash flow statement, the meaning of fund is cash, showing the changes in cash from one period of time to another period of time. That is the difference. Second, accrual. In funds flow statement, it is assumed that it follows accrual system of accounting. Accrual system, mercantile system. That means all the expenditure and receipts of the current year will be taken, whether paid or not, whether received or not. That's why all outstanding and prepaid will be adjusted in accrual system. So funds flow statement is based on accrual system of accounting, whereas cash flow statement is based on cash system of accounting. We assume that we are recording what cash is received and what cash is paid. Outstanding and prepaid will not be adjusted. Only cash will be focused. The next one, intermediate and long range financing. Funds flow statement will be prepared, which will help in making medium term and long term financing decisions. Whereas short term financing decisions, cash flow statement will be used. Next one, funds flow statement does not analyze the very short term solvency position. The very short term solvency position will not be depicted by the funds flow statement. Many a time what will happen, the funds flow statement shows that the fund position is good, working capital position is good, but still the business is facing the cash crunch problem, because working capital includes all current assets and current liabilities, whereas cash is only a part of working capital. So it may happen that working capital appears to be good, whereas cash position appears to be bad. So that is the problem, that in very short term solvency position will not be depicted by funds flow statement. It will be shown by the cash flow statement. One more difference is, in making funds flow statement, we will make a separate statement of changes in working capital. The two statements we will make in funds flow statement. The first statement, statement of changes in working capital. Second, statement of source and application of funds. These two statements are prepared in funds flow, whereas no two, only one statement will be prepared in cash flow statement. These are the differences between funds flow statement and cash flow statement. Now, preparation of cash flow statement. CFS stands for cash flow statement. How to make the cash flow statement? The cash flow statement is becoming more and more important for analyzing the financial position, for evaluating the financial performance, for short-term planning, financial planning. So its importance is increasing day by day. That's why Institute of Chartered Accountants of India, ICAI, has issued an accounting standard, AS3, explaining the provisions regarding how to make the financial statements. How to make the financial statements. So now financial statements in India are prepared according to AS3. Before issuing this AS3, in a tabular form, in T form, we used to make the cash flow statement, cash inflows, cash outflows. But after issuing this AS3, now cash flow statement will be prepared as per the provisions of AS3. Now I am going to explain how cash flow statement is prepared according to AS3. Now the ICAI has issued. The cash flow statement provides information about historical changes in cash and cash equivalent. Earlier, before issuing this AS3, we used to say cash flow statement is a statement which is prepared to show the cash position. Only cash position. That was the earlier stand. But after issuing this AS3, now it has elaborated. This cash flow statement will show the historical changes in cash and cash equivalent. What does this mean? I'll explain you. So this cash flow statement will show the historical changes in cash and cash equivalent from one period of time to another period of time. So showing, classifying cash flows into cash flows from operating, investing and financing activity. Remember this. So this AS3 explains that cash flow statement is a statement which is prepared to show the cash flows from operating activities, investing activities and financing activities. Separately, it is asking you to show all inflows and outflows regarding the operating activity, investing and financing activity. Now, before starting that, how to make the financial statement, you must be clear regarding the terms. The first, cash. Cash means cash in hand and cash at bank and demand deposit. There are two types of deposit, fixed deposit and demand deposit. So we assume whatever demand deposit, that means whenever we can withdraw the money, that is called demand deposit. Our money is in the bank. At any time we can withdraw it. That is called demand deposit. So cash in hand and deposit in bank in demand deposit, that is called cash. Now cash equivalent. Now concentrate here. Cash equivalent. These are short-term, highly liquid investments that can readily convertible into known amount of cash with insignificant risk of change in value. Remember, what are cash equivalent? Cash equivalent are short-term, highly liquid investment. These two terms you remember. Short-term, highly liquid investment which can be easily convertible into cash with insignificant risk in the change of its value. That means those investments which are readily convertible into cash. Example, government securities are there. The government securities have high liquidity. At any time we can sell the security and realize the cash. There will not be any change in the value. The value will be more or less same. No risk at all. So simple, cash equivalent means those short-term, highly liquid investments which can be convertible into cash within a short period of time with insignificant risk in the change of its value, right? That is called cash equivalent. So whenever we say cash and cash equivalent, means cash in hand, cash at bank and also highly liquid investments, short-term investments. Then cash flows. Cash flows means inflow and outflow. When we combine inflow and outflow, it is called cash flow. So when the word comes cash flows, it includes both cash inflows and cash outflows. Operating activity. Three types of activities are there according to this AS3. AS3 has classified all activities of the organization into three. First, operating. Operating activities are the principal revenue producing activity of the enterprise. Principal revenue producing activity are called operating activity. Example, a business is dealing in suppose cloth. A cloth business is there. So main activity of the business is to purchase the cloth and to sell the cloth. So whatever revenue generated from this activity of purchasing the cloth and selling the cloth is called revenue activity. Is called operating activity. It is called because this is the principal activity of the business. Principal activity of the business. So every business will have the principal activity. So revenue generating from this principal activity is called operating activity. Cash flow from operating activity are primarily derived from the principal revenue producing activity of the enterprise. Principal revenue. So every business will have the main activity of the business. That main activity is called operating activity. So revenue generated from that main activity is called operating activity. Now examples of operating activities are cash receipt from the sale of goods and rendering of services. Business organization will produce the goods, sell the goods and also provide the services. So any revenue generated by producing and selling the goods and rendering the services, that is called operating activity. Then second, cash receipts and from royalties, fees, commission and other revenue. So any revenue received from royalty or commission or these fees or then cash payment, because when we say flow, it means inflow as well as outflow. So when we say cash flow from operating activity, it means cash inflow as well as cash outflow. So here cash receipt is inflow, whereas cash payment is outflow. So cash payment to supplier of goods and services, the payments of cash to the supplier is cash flow. Then cash payment to on behalf of employees. These four I have given just an example of cash flows from operating activity. That means the receipts from sale of goods or rendering of services, payment to the suppliers, payment to the supplier of goods, and payment of salary and remuneration to the employees. All these things are cash flow from operating activity. Now investing activity. Investing activity are the activity pertaining to the acquisition and disposal of long-term assets and other investments. Two types of investment are there: short-term investment, long-term investment. Short-term investment already we have covered up in cash and cash equivalent. So cash and cash equivalent, short-term investment gone. Now long-term investment. Now purchase and sale. Remember, purchase and sale of fixed assets and long-term investments. The revenue generated and revenue paid and amount paid on purchasing the asset or sale of asset, purchasing of investment and sale of investment will come under investing activity. So examples are cash payment to acquire fixed asset. Similarly, cash receipts from disposal of fixed assets and also long-term investments. So cash received on sale of fixed asset, cash received on sale of investment. Similarly, cash paid on purchasing the fixed asset, cash paid on purchasing the long-term investment will come under investing activity. Now financing activity, third and last activity. Financing activity are those activities that result in change in the size and composition of owner's capital and borrowings. Two types of funds are employed in an organization: owner's fund and borrowed fund. So what is the size and what is the combination? So all the activities relating to the size and combination of owner's capital and borrowings, that will come under financing activity. So all the activities relating to raising of capital or raising of loan or repayment of capital or repayment of loan, that will come under financing. Examples are cash proceeds from issue of shares. When a company issues shares, it will receive the cash, that is financing. Cash proceeds from issuing debentures, loans, bonds. So share capital is the owner's capital, whereas bonds, debenture are the borrowed capital. So any amount received by issuing shares or issuing debentures or issuing bonds, that is financing activity. Apart from that, cash repayment of amount borrowed. Not only receipt but also repayment of amount borrowed. Similarly, payment of dividend on preference capital and equity capital. Dividend paid on equity capital and preference capital, that will also come under financing activity. So all the three activities I have explained. Now I am going to explain the points to be noted while making cash flow statement. First point, profit or loss on sale of asset. When an asset is sold, any profit or loss may arise. This profit or loss arised on the sale of asset will be considered in investing activity. Will be considered in investing activity. Similarly, interest and dividend. The interest and dividend paid should be classified as in cash flow from financing activity. The dividend paid, interest paid on borrowings, that will be considered in financing activity. Then taxes on income. Cash flow arising from taxes on income should be separately classified as cash flow from operating activity. The income tax paid should be considered in operating activity. Extraordinary items. If any extraordinary items are there, then we have to see where this extraordinary item is falling. Is it a part of operating activity? Is it a part of investing activity? Or is it a part of financing? Accordingly, we have to treat the extraordinary item. Last is reporting of cash flow on net basis. See, a net basis means we have to set off the inflow and outflow. We should not show all inflows and outflows. We should take the net amount. Example, operating. In operating activity, we may have cash inflow, we may have cash outflow. So set off both and find out the net amount. Similarly, investing activity. In investing activity, we will have cash inflows, we will have cash outflows. So make a set off of both inflows and outflows, take the net amount. Similarly, financing activity, inflow, outflow, set off and take the net values. So all the net cash flows will be calculated for all the three activities. So in this video, I explain you about the meaning of the term cash flow statement, cash book versus cash flow statement, importance of cash flow statement, differences between funds flow and cash flow, how to make the cash flow statement according to AS3, explaining different terms. What is cash? What is cash equivalent? Then what is cash flow? What is operating activity with examples? What is investing activity? What is financing activity with examples and some points. So in the next video, I'm going to explain you about the format of making the cash flow statement. So if you are satisfied with my lecture, give a like to the video. Share my channel in your group, in your friend circle, so that more students can watch the video and enhance the knowledge. And subscribe my channel if you have not yet subscribed, and give your comments on these videos. We'll continue the next part of this theory in the next video.